Okay, great.
Yeah, so my name is Neil Van Huis. I'm a partner and director of sales and trading here at BlockFills. BlockFills is a global financial services technology and trading company in the digital asset sector. We provide everything from liquidity, execution, and clearing services to professionals and institutions.
Got it. So, this is super interesting to me. I'm heavily invested in mining personally. We're trying to do investments in the mining space. The rate limiting factor from my perspective has been just the massive amounts of, you know, of capex associated with doing these deals, from buying power generation, setting up mines, buying rigs. There's really no financing. So everyone comes to me and says, I've got 300 megawatts, but they don't have any rigs on it. They may be mining 10 megawatts. And I'm saying 10 megawatts, the very few of them are mining 10 megawatts. It's always very, very small ball. So tell me a little bit about what you guys are doing.
Yeah, so our core business started off as a trading and prime brokerage business. All of our partners here have very diverse backgrounds in banking, bank trade execution, hedge funds, etc. So we wanted to bring a more transparent trading environment and a more professional trading and technology business into the space. Call it, when we founded ourselves in late 2017. So if you fast forward to late 2018 into 2019, we were getting calls from power brokers, we were getting calls from mining companies to really just help them out in better pricing, from OTC trading or trade execution or delayed settlement, all the things that you would normally want to get as a professional or a vetted institution in the space. So they came to us really saying, okay, how can I leverage my balance sheet? I'm a long-term player here. I've got a lot of crypto on my balance sheet, but I don't necessarily want to sell my Bitcoin or all of it. I want to leverage it to get access to dollar funding to grow my operations. And so we started off just like some of the other guys in the space that do collateralized Bitcoin lending. So that's a very normal product in the space. They give us Bitcoin, we give them dollars in return, we charge them an interest rate.
What does it look like specifically? Because I've looked at these scenarios. They're very high interest, highly collateralized loans. It's a non-starter. I mean, again, it's just.
Yeah, no, I'd love to talk to you about that and tell you why we're doing what we're doing next because of exactly the same point that you just brought up. So the traditional lending scope on this is, we give them $1 million. They give us 1.2 or 1.3 million dollars worth of Bitcoin, right? So a 70 or 80% loan to value.
Yeah.
Okay, so that backs the loan.
That's actually not bad. I mean, and just let me set the perspective here. If I took my brokerage account and let's say it had $1 million in it, the bank may give me 1-to-1 leverage on a brokerage account. So that's actually, they're holding the account, right? So that's really interesting. I appreciate that. Okay, keep going.
Yeah, so some lenders in the space only do like 50 or 65% LTV type things. We really focus on, we're traders. We know how to manage risk. We know how to manage this like a forward contract or a swap. So we basically developed this over-the-counter swaps business. They're usually 6-month to 12-month loans that basically have margin rebalances. So if the price of BTC moves and the miner owes us a little bit less Bitcoin because the dollar value of the loan versus their Bitcoin changes, we rebalance that by giving the Bitcoin miner back some of their holdings or by taking more, right? Mm-hmm. And so we've done that successfully for 12 months. In September of last year, what got really interesting is after doing all of that, over $125 million worth of swaps, wow, successfely.
What kind of losses did you guys take or have you taken historically?
Zero loss, wow. Zero early termination, wow, and 100% margin call rebalance success.
And is it just done like through a smart contract or algorithmically? There's no human like, whoops, I was switched off and missed, a big down move and we're taking an L here.
Basically, we run it like a traditional clearing merchant would in capital markets. We give them 24 hours to rebalance their account. And
Interesting. So it's like a margin call.
that
And
is,
so
it's a margin call.
yeah, that's really cool, actually. So it's not an automatic liquidation. And that's what a lot of people are dealing with in this space. You're actually doing a margin call and say, hey, we're not going to sell anything if you send us more Bitcoin.
Yeah, that's right. I mean, the difference between us and a lot of other players is we don't do any retail business, right? So I'm not worried. We're always worried that someone's not going to meet their margin call, right? But, I'm not dealing with retail people who are just going to run and dip out on me every time they get over leveraged, right?
Interesting.
So, these are professionals, they're institutions. We have done credit oversight on their balance sheets. We know intimately where their mining is directed through a mining pool so we can check their wallets. These are not guys on tilt, right? So in September, everyone started coming to us and saying, hey guys, we're starting to plan for the halving. And, we really think that, in 2020 and forward, we're going to have to leverage our balance sheets differently than we do today because, a new halving cycle represents a totally different opportunity than the end of a previous halving cycle. And at the same time, we have all this new gen equipment from the hardware manufacturers that's totally changing as the halving cycle occurs. So we're seeing guys using their balance sheet entirely different than they were in the last 2 years of the previous halving cycle. So what they need now is they need something that structures their cash flows because Bitcoin miners have very structured cash flows. We know how we can predict risk elements in those cash flows like the price of Bitcoin. But the beauty of Bitcoin and the market itself is mining and Bitcoin prices and the whole market is very self-fulfilling all by itself, right? If the price of Bitcoin goes down, so many miners shut off in the network because they can't afford to stay on. It leaves opportunity for the more well-capitalized or more opportunistic miner who then stays on, has better rewards, and actually gets an edge from lower prices. And at the same time, the equipment market or the ASIC hardware that they're buying ebbs and flows in pricing based on the demand and the supply of the market, or the price of Bitcoin, right?
So do you guys allow miners to borrow or leverage their Bitcoin to buy hardware, their Bitcoin to buy power gen, their Bitcoin to buy anything? Or are you then doing diligence on the mining hardware, on the power generation? I mean, do you guys have that full suite of capabilities to understand that?
Yeah, so that's basically what we launched, but by their request, right? And we knew that there was going to be a number of risks that we needed to evaluate in this scenario. One of those risks is just their own financial credibility, right? So we're only focused on well-capitalized participants that have been around in the space. That's number one. Number two, we're not interested in financing more miners on riverbanks in China. There's a risk to their business in general. There's also a risk to having the majority of mining done in China. So we want to, all of the people that come to us looking for a solution are people that genuinely want to diversify their operations geographically because they're fearful that more mining in China leads to more risk for the Bitcoin network.
Interesting. So do you all share that philosophy of like concentration of mining leads to a risk in the general security of the mining protocol? So you're actually actively working to diversify locations of Bitcoin mining to strengthen against a 51% attack. And I think that's what we're talking about.
Yeah, we're not, generally speaking, that is not like a forward concern of ours. What we're more interested in viewing is that is a risk, both to the network, but also to us financially, because there's been many stories published about, very reputable companies buying $10 million worth of equipment, putting it on dirty container sites on a riverbank in China to get low cost power during wet season and not in wet season. And then the floods happen and $10 million of equipment is gone. So what we're focused on here is, number one, what we consider tier one participants in the mining space. Number two is we're currently only developing solutions for North America and one other geographical location that's very opportunistic. And so in North America, what we
Mongolia?
do, unfortunately, Mongolia is not on the list. But hey, you know, for some people that might be really great.
I don't know. You said one opportunistic location. I just threw one out there. I didn't know if it may be
That's just
North
one
America
opportunistic
and
location.
Mongolia, but it's
For
not
sure.
Mongolia. Okay.
So basically, we want to focus on North America for a number of reasons. One is North America has plentiful and low-cost power, and we.
In your opinion, how does it stack rank against the rest of the world? Is it one of the safest and cheapest places in the world to do it, or is Iceland better, China better? I mean, where do you guys kind of priority rank?
I would consider it one of the top places in America, definitely top 5. You know, for me. And there's a number of reasons why. To disclose why that is important to view that way. It's not just about power. And you and I have talked a little bit prior to this recording that there's a lot of people with a lot of power out there. And they can say, hey, I've got all this power. And having power is one thing. Having infrastructure to support a mining operation is totally different. Also, most of those sites can say, sure, I can get you cheap power. It just comes at a per megawatt CapEx cost for the mining company to come in. So what we found in North America is there are a number of leading companies in the space that have developed their own sites by getting investment, building infrastructure, and building everything a miner needs to have to just plug and play their machines when they show up. And while doing that, they still offer competitive rates on energy.
What do you guys look at as competitive rates per kilowatt?
Yeah, so I think 4 to 5 cents is considered per kilowatt hour is considered competitive right now. Anything lower than that is in the top tier of energy rates in the world. So if you're getting, you know, 2 to 3 cent power or 3 to 4 cent power, you know, you're doing something well. But one thing that's really important, again, to wonder about someone who's getting sub 4 cent power is how they're getting that power. In some places you can get it, and you can get it by buying, right? If you're coming in as a major player consuming 100 megawatts plus, you can negotiate rates like that. Outside of that, you're not going to get sub 4 cent power, in my opinion. If you get into the 2 to 3 cent power, it's normally because you're using, you know, blended forms of energy. Could be wind, could be solar, could be flare, which is becoming more interesting and more popular in the space down in places like Texas. But that comes with its own caveats. When you use flare gas, you're basically dropping down natural gas to natural gas generators. And when you drop that down to a natural gas generator rather than a substation that you're pulling directly from the grid, you have to service those natural gas generators. And that leads to a lot of downtime. Nat gas generators, and my family's been in the data center and generator business for 25 years, they can be a real pain. You take them down for normal maintenance, it is going to be, when you finally add all the time up, it's going to be a lot of downtime for a miner.
Yeah, Neil, I've talked to companies that want to own that process end to end, and have pitched me that not only are they going to mine, not only are they going to use these waste gases or flare gases as their fuel source, they want to own the reciprocating engines, you know, and they're trying to get financing for it. And I just look at them and I say, are you an engineer? I mean, do you understand? Like, I've been running power generation for the last 5 years, not 25 years. These things break, and they break often. And every time they break, you have to go to the grid for power to keep, you know, the mines running. And if you're in some stranded, you know, the middle of the Permian, and there is no grid,
that's right,
just a flare, and that steady stream of flare gas is on and off. I mean, come on, man. Like, what are we talking about? That's
it has its totally different risks than in other scenarios. So the way we look at it, and you're exactly right about that, you know, everyone's so excited about Permian, but it's absolutely in the middle of nowhere. And, you know, sure, there's a lot of nat gas, but there's a lot of nat gas everywhere. You know,
5 years ago, before I started doing this power generation, I was beautiful.
Yeah.
Look, I look crazy. I have a mullet. I wear a baseball hat. I got like a face. I mean, this is like crazy what I look like now. That's what
No,
happens when you
honestly,
try to mine off a flip.
yeah. When you try to mess with generation and mining all at the same time, you're taking on the stress of crypto and power.
I'm sorry. I'm just it's funny, but I love
Right.
the way you're looking at this. So North America, 2 cent power, you got to scratch your head. Something enormous is going on. You've got an amazing innovation. 3 to 4 cent, 4 to 5 cent is like in your wheelhouse. You guys are interested. You may lend on that. A question: have you come across any companies that are generating power, mining crypto, but they're taking an approach as something called like a peaker plant? So what they're doing is they're switching off their mining when they get a signal that there's a peak load demand on the grid, and they've gone through an interconnect. So they're getting tremendous arbitrage on their power generation. So they may mine and have like a Bitcoin crack spread of, unless I can sell my power for 15 cents a kilowatt hour, I'm mining. But in the event the peak load demand comes off, and now I'm able to sell a megawatt hour for like $100 or $150, they'll stop mining. And what they get is a effective blended price per kilowatt hour of nearly zero. Have you come across anyone doing that in the world?
Yes.
If not North
Yeah.
America?
Yeah. I think we're both aware of the couple of folks that might be looking at that. I would just say that while that is fine, and I totally get that model, there's a difference between a company that has all that available to them and a company that has to build all kinds of things and spend a lot of money to extract that type of arbitrage.
Yep.
Because there's a short game and there's a long game, and then there's a very stable game. And so I think that there are a couple of folks that are well positioned to start doing those types of things. And I think that those are guys that are playing the long game, and that's totally fine.
Because in
But
full transparency, that's what I've been building at PRTI for the last 5 years.
yeah,
It's like I generate power. I understand, because we've been mining for years, what we call like a crack spread,
hmm
right? We have the interconnect agreement, right? But we've always looked at ourselves as a peaker plant, and we need to be able to switch the rigs off and go to the grid when peak demand hits, because these peaker plants sit idle 70-80% of the year. So they spend 50 million bucks to build this power gen, and they just sit idle. People don't understand the enormous amount of power that is available that we don't use. It sits idle most of the time.
that's
When
right.
that peak demand hits, bang, you got to be there. So there's not a lot of them out there.
No, that's right, and it's very opportunistic. Like I said, if you have that at your disposal just because that's how you built out your setup, that's fantastic. For guys who want to enter the sector, and for you know for the most part have to raise $50 million to build that, to get that.
And
You
the
know,
years and years of engineering to get the interconnect agreement, to negotiate a
it's a
PPA.
smart idea. It's a smart idea. But for me, if I was going to say invest in a company that has to build that infrastructure to get that edge, I would rather go find a crypto miner that mines in the 3 to 4 cent range, that has agreements with the regulatory powers in those places for the energy, so they never get turned off.
Yep.
And they get demand response programs to give them incentives, albeit it might not be that big
Right.
arbitrage. They're getting something.
Yeah.
Then those guys
And
are
the
who I
mines
invest
aren't in a chicken coop,
in. Yeah,
right? They're
without a doubt.
actually, they may be in Connex, but they're stable. They may be in like they're in an environment that, a flood's not going to come through and wash them away. I appreciate what you're saying, because I've seen all kinds of gimmicks and pitches and garbage setups where things just look crazy. And when you think about putting millions and millions of dollars of capital expense in very sophisticated mining equipment that can be unstable in the best of environments, let alone, it's 100 degrees outside with 98% humidity and all the other things that go into this. I really appreciate your level of conscientiousness here. How did you guys become so boned up on crypto?
Well, we're all traders. We see opportunity in markets. And so, in 2017, we saw that, buying crypto on Coinbase through an app, you were paying prices you didn't even know where you were paying. You're just clicking the button and it's like, oh, I just paid 10% more than what the Bitcoin was worth. And at that time, volatility was so ridiculous that, you could have been right and it would have been 100% in your favor shortly after. But nonetheless, we wanted to build more professional solutions. And so, when you get into this is really like being a trading business or like an exchange business, but also being like an investment bank at the same time. And so, or financial services. So we want to be like really well-rounded. We want to support the community that keeps the community going. And that really is mining. And we've done really well on that. And so, we want to focus on North America right now because everyone else seems to be, the miners themselves seem to be focused on North America. So, hey, how can we get you equipment? How can we get you to sites that make sense? How can we give you sensible liquidity so that you can get access to this and scale your business? So most of these guys have 10 to 50, in some cases 80 megawatts of crypto mining online already in other locations. So they're not new to this. They just want to methodically roll out new equipment in new geographies. So we built a Bitcoin hash rate structured product is what we call it. And so what we do is let's say we give them $1 million or some amount of dollars to go buy brand new equipment. We own the equipment until they pay off the loan. Okay.
Yep.
So
and then they pay you $1 at the end.
Well, something like that. Yeah.
They do that in medicine. It's literally
it's a payoff amount.
We finance it, and at the end, it's like a buyout of the structure for $1 or something like that. I don't know how you do it.
So we run it just like a structured product or a structured financing scenario where if we lend them this much money and we've collateralized the loan with the ASICs right now, what we know as our hedge is everybody seems to want ASIC hardware in North America because it's coming from Asia. So it's a hot commodity in North America, right? So we know that we've got hardware that is new, that is a new gen equipment in a new halving cycle. So it's powerful, it's valuable. The second thing that we know is that if they default on North American soil and we need to resell it, we should be able to get buyers for that. So that's extra protection. So then what we do is we structure their principal and interest payments on a weekly basis. So they're just delivering us Bitcoin once per week, like they normally would to anyone else, like an exchange, to sell their Bitcoin for dollars. Instead, they send it to us. We sell it for dollars. We service the payments to our investors and our counterparties by giving them the principal and interest payment that that they deserve on their schedule.
Hold on. That's interesting. Are you also charging or collecting a tolling fee on that? So it's going through a different division of BlockFills. So you financed, and I'd like to get into what that financing looks like. You financed ASIC rigs. Let's say I bought $1 million worth of ASICs. Right now they're $3,000 each or something like that. So I bought S19s. You financed them. I have those rigs running. It's about $1 million a megawatt, I think, by my estimation. So I've got a megawatt of power running. And what are the terms for me to finance that?
Yeah, so I can, typically what I do is I run your ASIC type, your power cost.
S19, 4 cents.
I run it through a profitability calculator and I look at like how much room do you have, based on what you owe me in principal and interest. And I decide to give you a 12, 18, or 24-month loan. That's it.
Got it. And can that loan be re-upped, or is it called at the end? There's no balloon. It's just bang, you owe.
That's it. And at any time during that point, we can service more loans for more equipment. It's just Each loan is for an equipment deployment, segregated each and every time. There's no balloon, there's no nothing. It's just a simple structured principal and interest calculation that's broken up over the amount of payments of the term of the loan.
All right. So let's just say I'm using Slush Pool. I'm paying them 1%. The tokens are going to your wallet. You take your payment every week. Are you charging a fee to sell that Bitcoin?
So not really. So basically we run a spot trading platform, just think of us as an exchange.
Yeah.
So when they send it in, we liquidate it at today's spot price immediately, and we service the payment to the lender and the borrower.
Okay. And can you tell me what the terms are in terms of a percent? Like if again, I borrow $1 million, I want to do 1 megawatt of mining. What are my terms?
Yeah, basically, depending on your credit, depending on your financial abilities, the rates are going to be anywhere between 10 and 12% generally.
Well, that's actually not bad.
Annually. No,
That's actually not bad. So I don't want to choke on that. That's not venture. That's not credit card. That's not bad. And all right, that's exciting. Actually, that's really exciting. 10 to 12%. You certainly can service that kind of debt.
Yeah, and what we do is, so we've reduced the risk because we know the market. We reduce the risk by putting on North American soil. We reduce the risk by making there be a weekly payment frequency, which is better than other fixed income instruments, right? And what you get from an investor standpoint is, let's say Jason wants to give Neil $1 million to go give to a crypto miner. What I've now done is I've allowed my investor to tell me whether he wants his principal and interest in dollars, principal in dollars, interest in Bitcoin, or all of it in Bitcoin. So if there's investors out there that want to get access to Bitcoin denominated yield, we can do that. We can, if they send us 140 grand every week and 100 of it is principal and 40 is interest, well, I sell them and I give them their principal back in USD, and now they got $40,000 in Bitcoin. So it's interesting for the investors that want indirect exposure to Bitcoin.
How are you custodying the Bitcoin? If an investor decided to do this, where are you sending the Bitcoin to hold it? Are you holding it internally, or is it being custodied by a third party?
They can choose to put the Bitcoin wherever they want. It's not our asset as far as we're concerned. If you want us to hold it on account for you like we do for other trading firms, by all means, we'll do that with our Fireblocks vault. But outside of that, you can take the Bitcoin wherever you like.
What type of arbitrage am I getting as an investor? Let's say I send you the $1 million to BlockFills, and then you loan the $1 million. You're loaning it at 12%. What am I making?
Yeah, so I mean, if I'm generally speaking servicing all of the execution, the back office administrative, I'm making I'm making anywhere between a 1% and 2% spread at any given time, I think.
Yep. And that's annual.
Yeah.
Right. So me as the if I'm the funder, and I don't know if there's a mechanism like this at BlockFills, but me as the funder, I give $1 million, you loan the $1 million, you're going to scalp 2% in terms of fees. Does that mean I'm getting 10% return on my money?
Yeah.
Mm-hmm. And is that the way it's structured?
That's the way it's structured.
That's pretty cool.
Yeah.
I mean, really cool.
And what we do to protect both the investor, ourselves, and the miner as well is, what we've done here is we've eliminated as many risks as we can, but we still have one major risk in the room, and that's if Bitcoin were to drop drastically in price in a very fast fashion, this can hurt people. It can hurt the servicing of the payments, everything. So what we do is we structure an option strategy with zero cost options. So what we'll do is we'll design what's called a string of options using collar strategies or others. We can use other strategies, but we'll basically buy a put and we'll sell a call. And what it'll do is it'll fix the upside for what the miner is doing, but it'll totally protect them on the downside in the event that Bitcoin drops below a price that they don't want. And it'll come at really no cost to the miner. It shouldn't really come at any cost to the investor unless there's a rapid move in the right direction of Bitcoin, up, right? And then we will actually have a margin call on those options. So what we'll need is to either choose to sell out of that option position that we had and make a Bitcoin payment, or we'll need to put up collateral to maintain that position. But what might be attractive at that time, which is very common in traditional capital markets, is we might use other options to mitigate the margin calls or mitigate the outlay, so that no one's really burdened by that, or find the lowest cost scenario to the miner so he's not giving away a ton of upside on his Bitcoin execution.
Got it. And in my experience over the last 5 years in mining, I can't get an insurance product. I can't use traditional banking to protect anything. It's literally like, it's just, I'm out in the desert, on some foreign land. Have you created or worked on any traditional insurance programs that are backing either the hardware, the strategy, anything like that, whether it's like reinsurers or insurers?
No, I think that one thing that we have looked at is kind of like a credit default swap for mining. I think that the market's not quite there yet, and the reason why is, usually you create derivatives, then you create more derivatives, then you create more derivatives, and that's how you get to the credit default swap. And so, in my opinion, we've just finally got some real volume. The biggest options expiry ever in history will exist tomorrow for $1 billion worth of Bitcoin notional options. We expect that number will be trounced pretty soon. So that's really step one: futures, options. Build a robust marketplace. Now, a structured product like ours, or, hash rate derivatives, which is all the rage and topic right now that, people are all working on. We want to list our structured product next. We want it to be a listed liquid market.
Wow.
On our platform or in other venues. I think that's when you can bring the insurance product in right after that.
Okay. Very cool. Look, I think this is super exciting. I think I'd like to take the rest of our conversation on another call. If you could send me the deck, because I haven't seen a deck. I don't know if you sent it to Chris. I'd love to see the deck. I'm super interested in what you're talking about from an investment perspective. I think this makes a lot of sense. We haven't, as a firm, actually put money into mining yet. This is an interesting way to do it.
Oh, that sounds great. Well, listen, I'll send everything over, and I just appreciate the great conversation on it. We've been working on this, like I said, to build the product since September of last year. We're just about to deploy the first bit of funding in less than 2 weeks to the first miner. I've got a $50 million portfolio ready to go, and I believe that all of those clients will be doing structured rollouts of more equipment every quarter. And so we expect to be able to do $50 million worth of these types of things every single quarter for at least the next year. And then we'll see what the hardware market looks like. We'll see about 7 nanometer chips. We'll look at all that stuff, in a year, and we'll see where things are at.
It's awesome. No, it's super exciting. Obviously, you're bullish on Bitcoin. You're bullish on mining. I am too. I mean, I couldn't be more committed to it. It's an amazing space. And when you think about pre this halving 2020, the newest tech was the S9, and it was mining at 13.5 terahash per second. Now we kind of had a little glitch with the S17. We're using S19 Pros. These things are mining at 110 terahash per second. I mean, it's like almost a 10x increase in mining power and hash rate. I mean, Moore's law is real. Can we continue to 10x, in terms of the innovations in mining and capture that type of efficiency? It's crazy to me.
No, you nailed it. I mean, when you look at the deck, you'll see that those are the exact points that I'm talking about. These guys are computing at 6 to 10 times what they were in the previous generation. What that tells you is that the market is expanding, and that for every $50 million that I'm putting out in financing for machines, the infrastructure money that's being pumped into the mining space is well over 2.5x that. And so, when you look at it and you look at the computing power, what you're finding is that whoever is going to be participating in the space, going forward, has to be doing it at scale. And so that's a big reason why liquidity needs to come into the space, and more structured financing needs to come into the space as well.
Love it. Look, you guys you're crushing it. This is super exciting. I'm going to end the recording. And thanks for your time today. This was awesome, man.
Yeah, appreciate it very much, Jason.
All
Thanks.
right, we'll follow up. Shoot me the deck, okay?
Will do.
All
Thanks
right,
a lot.
bye-bye.